Before you can build an AML program, before you can calibrate a transaction monitoring system, before you can make a decision about filing a suspicious activity report, you need to understand precisely what you are trying to prevent. Money laundering is the process by which the proceeds of crime are made to appear legitimate. That sentence is deceptively simple. It contains three components worth unpacking. First, proceeds of crime. Money laundering requires an underlying criminal act. There is no money laundering without a predicate offense, the crime that generated the funds in the first place. Second, made to appear. The goal is not simply to move the money, the goal is to change its apparent character, to transform funds that are traceable to criminal activity into funds that appear to have a legitimate source. Third, legitimate. Integration into the legitimate economy is the endpoint of successful money laundering. Once that endpoint is reached, the criminal can spend, invest, and display wealth without triggering the questions that unexplained cash or assets would provoke. Understanding this objective is the foundation for everything else in AML. Money laundering is conventionally described as occurring in three stages: placement, layering, and integration. These stages are a framework for understanding the process, not a rigid sequence. In practice, the stages can overlap. But the three-stage model is the exam framework. Know it precisely. Placement is the first and most dangerous stage for the launderer. This is where criminal proceeds, most often physical cash, enter the financial system for the first time. It is the most dangerous stage because the funds are most traceable to their criminal origin at this point. The cash still smells like crime. This is why placement attracts such intense regulatory focus from authorities worldwide. Techniques used at placement are designed to break the direct link to the source by fragmenting deposits or blending proceeds with legitimate revenue, by physically moving cash across borders or converting it into other forms like crypto assets. These are key detection opportunities for compliance. Layering is the most complex stage of money laundering. The objective is to create distance between funds and their criminal origin. This distance is created through multiple transactions across institutions and jurisdictions. The more layers, the harder the trail to follow. Shell companies and nominee structures are common, as they have no genuine economic activity and obscure ownership. Rapid wire transfers across countries further break the investigative trail, making it nearly impossible to follow the source of the funds. In loan-back schemes, launderers make criminal funds appear as loans, which they then repay with legitimate income. This creates a normal-looking paper trail that makes the funds appear to come from a legitimate borrowing transaction. Finally, trade-based laundering uses over or under invoicing to move value across borders under the cover of legitimate commercial activity. Integration is the final stage, and the hardest to detect and prosecute. Layered funds re-enter the legitimate economy in a form that appears lawful. If successful, no obvious connection to the predicate crime remains. The funds are now indistinguishable from legitimate wealth. Real estate, purchased with laundered funds, held, then sold, generates proceeds that appear legitimate and are difficult for authorities to challenge. High-value assets such as art, yachts, and luxury vehicles can be purchased anonymously and are difficult to value, resold, or used as collateral. Investing laundered proceeds into legitimate businesses creates real revenue, pays real taxes, and employs real people. Over time, criminal funds become indistinguishable from legitimate income. That indistinguishability is the definition of successful money laundering. A money mule is an individual who receives criminal proceeds in their own bank account and transfers those funds on behalf of a criminal organization. They may either retain a commission or be entirely unaware of the criminal nature of the activity they are participating in. Money mules sit at the placement and layering stages, adding a layer of distance between the criminal source and the money's destination. There are three categories worth knowing. The first is the knowing mule, someone who understands they are involved in crime for financial gain. The second is the unknowing or deceived mule, someone recruited through job advertisements or scams that present the arrangement as legitimate. The third is the coerced mule, someone threatened or forced into participation against their will by a criminal organization. From an AML perspective, the category matters less than the pattern. What matters is the behavior, rapid receipt and onward transfer. Transactions that are inconsistent with the profile and have no obvious purpose are what transaction monitoring systems must be calibrated to detect. Predicate crimes are the offenses that generate the criminal proceeds that are then laundered. Under the FATF framework, which underpins AML law across most of the world, there is a designated list of predicate crime categories that each member jurisdiction is required to criminalize. This matters for compliance professionals for a specific reason. The predicate offense shapes the typology. Drug trafficking generates cash, often large volumes of it, often at the placement stage in cash-intensive businesses. Fraud generates electronic funds, often moving through multiple accounts rapidly with a clear victim. Corruption generates funds that appear legitimate on their face, payments from government accounts, consultancy fees, or contracts awarded to connected parties. The indicators you look for and the risk factors you apply should be informed by the prevalent predicate crimes. That is precisely why Europol's SOCTA and national risk assessments are not academic documents. They tell you which typologies should dominate your monitoring framework based on active predicate crimes. Sanctions evasion became a predicate offense under EU law in 2024. Helping a sanctioned party access the financial system, moving assets or facilitating payments, is itself the predicate from which money laundering charges can flow. Corruption generates funds that appear legitimate, consultancy payments, commissions, and government contracts. The funds do not look like criminal proceeds because they flow through a bank in a documented transaction. The predicate is the corrupt arrangement, not the form of the transfer. Tax evasion is a predicate offense in most FATF member jurisdictions. Tax avoidance uses legal structures to minimize liability. Tax evasion involves deliberate concealment of assets. The distinction is legal versus illegal. Fraud takes many forms. Investment fraud generates proceeds that move rapidly through multiple accounts. Payment fraud, including authorized push payment fraud, generates proceeds frequently routed through money mule accounts. Trade finance fraud uses falsified documentation to extract payments for non-existent or misrepresented goods. Cyber-enabled crime is now inseparable from money laundering. Ransomware generates crypto proceeds that must be laundered. Business email compromise fraud intercepts legitimate payment instructions and redirects funds to criminal accounts. Romance fraud and social engineering attacks generate funds that flow through mule networks into the banking system. A compliance function not monitoring for cyber-enabled crime is missing the dominant predicate category of the current threat environment. TracFin's 2023 data showed payment institutions accounted for 31% of French STRs, the direct consequence of this shift. Financial crime carries consequences that extend far beyond the institution that failed to detect it. The CAMS examination tests understanding of consequences at 3 levels: social, institutional, and individual. At the social level, money laundering allows criminal networks to expand and reinvest proceeds from drug and human trafficking. It is the mechanism that makes serious crime, from exploitation to environmental destruction, sustainable and viable. At the institutional level, an organization that fails in its AML obligations faces regulatory sanctions and reputational damage. The Trésor case showed a €1 million fine, but major international actions have produced fines in the billions of dollars. Beyond the fine, loss of license and management accountability are existential risks produced by compliance failures. At the individual level, officers and managers can face personal liability and criminal prosecution for AML failures. 3 levels of consequence. All are critical points for compliance professionals.